At the beginning of 2024, the prospect of lower mortgage rates in 2025 seemed promising. Experts predicted that falling inflation and interest rate cuts by the Federal Reserve would make borrowing cheaper. However, as we move closer to 2025, the outlook has become less clear. Mortgage rates remain high, and the economy is volatile. Adding to the uncertainty are the proposed economic policies of President-elect Donald Trump. The average 30-year fixed mortgage rate has moved between 6.5% and 7.5% over the past year. Hopes that rates would fall to around 6% by the end of 2024 and into the mid-5% range in 2025 have faded. Recent trends show rates climbing back up towards 7%. The market is clearly volatile. HousingWire's lead analyst, Logan Mohtahsami, predicts that mortgage rates will range between 5.75% and 7.25% throughout 2025. Several key factors will have a major influence on mortgage rates in 2025. Inflation is a crucial measure of economic health. High inflation reduces investor demand for long-term bonds, leading to higher mortgage rates. President-elect Trump's proposed tariffs and tax cuts could stimulate demand and increase deficits. This could reignite inflation, causing the Federal Reserve to delay rate cuts. The Federal Reserve's policies will also play a critical role. The Fed has signaled fewer interest rate cuts in 2025 than previously anticipated. Recent changes in the central bank's language regarding rate cuts have already pushed mortgage rates back above 7%. The Fed now expects to cut interest rates by only 0.5 percentage point in 2025, compared to the 1% projected earlier. President-elect Trump's economic agenda adds another layer of complexity. His policies, which include a universal 20% tariff on all imports and a potential 60% tariff on imports from China, could fuel inflation. These tariffs would likely raise consumer prices, potentially leading to higher mortgage rates. Trump's fiscal policies could also widen the federal deficit. This could impact borrowing costs and push mortgage rates higher. Mortgage rates in 2025 could vary widely depending on how the economy performs. In a best-case scenario, a weakening economy, falling inflation, and a declining labor market could push mortgage rates down to the lower 6% range or even below 6%. This would require a significant drop in 10-year Treasury yields and a more aggressive approach to rate cuts by the Federal Reserve. In a worst-case scenario, a strong economy, persistent inflation, and increasing national deficits could drive mortgage rates up to or above 8%. This scenario would be driven by higher bond yields and a cautious approach by the Federal Reserve. Even if mortgage rates fall by 1% in 2025, buying a home may still be out of reach for many Americans. Home prices have surged by more than 40% since 2020. While price growth has slowed, prices are still rising at 5.1% annually. Experts predict a 2% increase in home prices in 2025. The housing market is also grappling with a shortage of 1 to 4 million houses, which is exacerbating the affordability crisis. The rate lock effect is another factor contributing to the housing market's stagnation. Potential homebuyers should focus on the factors they can control, rather than the macroeconomic issues affecting the housing market. Saving for a larger down payment can lower your mortgage rate and reduce your monthly payments. Boosting your credit score can help you qualify for better mortgage rates. It's also crucial to evaluate your overall financial readiness. Make sure you are prepared to handle all the expenses that come with homeownership.